Hey guys, welcome to today's stream. I'm just sending a message in the Discord so the guys in the Discord know that we've gone live and that they can jump in on this session. So just bear with me for 2 moments while I just send the link into the group. Okay, there we go. The link is into the Discord. Now, for the guys who are watching this, whether you're on Instagram, X, or YouTube, if you've not attended one of these sessions before, it's basically a super chilled session. There's nothing too serious that we go over. I usually take a look at somebody who's in the audience. I take a look at their track record and I analyze if there's any low-hanging fruits from any of the variables that we track here at Darwinex to see if there's any improvements that can be made to your trading strategy. Sometimes we find some things, sometimes that we don't, but the purpose of these sessions is mainly for the newer guys who we have trading at Darwinex Zero to come in and experience or investigate new variables in their trading, right? Generally, what happens for the most part is somebody will start trading, whether they see success or not. Somebody will start trading, they will get a mentor, they will learn a system, and they become very reliant on things like technical analysis, which is absolutely fine. If your model is based around a technical pattern or an indicator, what have you, that's absolutely okay. However, the caveat to that is if you get so enmeshed in thinking that that technical pattern or that technical variable is the only thing that's stopping you from being successful as a trader, you couldn't be further from the truth. There's 1,000,001 different variables that you can track and analyze as a trader, and there's certain variables that you should, or every single trader should, be aware of. And therefore, that's the purpose of these sessions, so that we can enlighten some of you guys to see what variables you can take a look at that are more statistically robust than looking at a chart and saying, I think this is going to go up because there's an area of support or resistance here. Sid said, I see you more than I see my own family nowadays, loving the live streams. I mean, I take that as a compliment. Welcome back to today's session. Anyway, Sid, it's a pleasure to have you here. I actually started this session 5 minutes late, so I do apologize for that. I was sending an important email and I had to make sure that it was done and dusted before we started here. So I was running down the clock. But I appreciate everybody who's on the session thus far. If there's anybody here, I know Rob from the Discord was keen on having his Darwin analyzed last week when we had the guys from EdgeOneCon. But Rob, if you're here watching it now and you want me to go over your Darwin, I know what your Darwin is. Just let me know that you're here. I'll load it up and then we can take a look at that, because Rob has been absolutely smashing it recently. The one you can see on screen, that is my Darwin right now, which is as well had a phenomenal month. I'm up 4.85% for August. Currently ranked 20 out of 8,701 traders in silver, which is phenomenal, right? And it's quite hard for me to believe, not to kind of blow smoke up, my own backside, but I was a discretionary trader for the past almost 7 years. And in the past 6 months, I made a transition from discretionary trading across to automated trading for a few different reasons, but mainly because I kind of fell out of love with discretionary trading, and B, my job at Darwinex got so much more important, and I had more responsibility and more things that I had to do, and therefore it was putting strain on my trading because I had less time to trade and to give to not just the markets but the testing, the building the alpha, like everything that comes with trading, right? And so I wanted to go into more automated or a more automated approach. And I come from a data analyst background. So I was a data analyst before I became a trader. And so it kind of made sense to me to build a portfolio of statistically robust systems that are uncorrelated in nature from one another, focusing on mitigating drawdown as opposed to generating the highest return possible. And then here we are today, right? 6 months later down the line, and build. Sorry if you can hear my dog barking. Bear with me 2 seconds. Up here now. Wait. Okay. Sausage. Sorry about that, guys. I didn't want her to deafen anybody because she's behind my desk barking. Mr. Player said, "So does strategy stop working in time, or is it just a myth?" That's a fantastic question, and it completely depends on the strategy, right? If you're trading something that is super reliant on a specific market environment, or something that it all depends on the variables, right? But the simplest one I can give is if you were trading the Japanese yen as a carry trade, right, when there was a differential in interest rates and you were just basically profiting off the swap fees, as soon as those interest rate differentials are eliminated, that edge is therefore no more. If it's something more simple, I tend to find that the more simpler strategies work over a longer period of time. The more complex something is, and the more room you have for that edge to decay. Okay, so the more rules you put in place, the more complex it is the more chance there is of that strategy falling apart. In my experience, anyway. If what I'm going to do, I'm going to hide some of it because this is all proprietary to my systems. But I'm going to show you one of them. So this is a strategy that I have running on XAQB, on that Darwin that you've just seen. The whole idea of this strategy is there is no technical analysis. There is no macro analysis. There is nothing that you would learn from watching a trading course, right? There's nothing like that whatsoever. However, this edge basically looks for, if the S&P 500 has a bearish day on Friday, it will buy the market open on Monday. Now, of course, I've had to curate it to a certain size, like limits in place for the size of the candles, for spreads, so when the market opens, it doesn't just get blasted on spread. And of course, how far the Monday generally runs. Now, this idea was actually pitched to me by a close friend of mine who is a beginner trader, and he said it as an idea, right? He said, "I've noticed something really weird. When the S&P closes bearish on Friday, generally it has a bullish day on Monday." And I said, well, let's test that theory, right? So I put this strategy together, and lo and behold, I'll show you the equity curve. So this is over an 8-year period. Okay, so you can see since the beginning of 2018, this is a back test, so this isn't live results. I use real tick data. I download all of the tick data too, so that there's no loss in tick quality or data quality. I run Monte Carlos on this. I add commissions and real live spreads. So the data is as accurate as I can possibly make it. Okay, and actually this system has been performing really well. It performed this week, which I'll bring up momentarily. Hey Rob, how's things? But again, this is going back to my original point, is this is such a simple idea, right? Over 8 years, it's made on a $100,000 balance, it's made $7,070 on the back test. Slightly higher now because it's had a couple more winners. The idea of this on its own is pretty pathetic, right? You may as well just invest into the S&P. You'll get a much higher return. However, when this is part of a portfolio, it's just one sub-strategy, it can work really, really well. Yeah, Rob, we'll do SPWL. I was waiting for you to join, so I'm just kind of rambling on about something that hopefully is interesting to you guys. But the idea here is there is no secret sauce to this. There is no complex technicals. There's nothing crazy. This is simply saying, and it's a weird edge that just came about by a conversation. If the market closes red on a Friday, buy it on a Monday, only for the S&P. Of course, it's not going to work on every other asset, and that's why we go through this testing period. Again, I've ran Monte Carlos for it, so we have best case, worst case scenarios, which you can see down here. But that's just one example of the kind of variables that I'm looking at. Not to say that this is right and, looking for technical variables is necessarily wrong, but just think outside of the box. That's a whole point of this session today, is to think outside of the box and to understand, that there's edging a lot of different things outside of a chart. So if I bring, let me get the S&P, all history. So this was the trade this week. You can see just that candle there. So if we bring it onto the daily time frame, You see, Friday was a bearish candle. I know it's hard to see because, let me get rid of the strategy tester. I know it's hard to see because all my candles are the same color, but you can see from where it opens to closes, it's a bearish candle. Market opens on Monday. The stop is below there with some room for maneuver, and then it buys on the way up. First scale down to the 15 just so that we can see it. Oh, wrong one. And then we can see, where is it? There we go. Market opened, it bought, take profit, and then move on. Okay, so my whole point about this, again, it's not, oh, look at me, look at my strategy. There is so much edge out there and little edges that you can exploit. You don't have to find this holy grail master system. You don't have to sit watching a chart every day to learn everything about every single candle and what happens. So just bear that in mind. That's a point of these sessions, again, to go over different variables to understand, is there any sort of edges like that you can exploit. I can see there's quite a few comments, so I'm just going to go through them now before I ramble on for too long. To go back to Mr. Player's question, that's the whole point of why I was talking about that. Do some strategies stop working over time? Yes, they do, but the more simple they are, the more robust they are. Going back to this equity curve, again, it's not perfect, but you can see there's no real change in behavior over the 8-year period. Of course, it has good weeks, it has bad weeks, but the equity curve is pretty smooth. If your equity curve is massively dependent on certain months, certain years, certain days, that's when you might come into a problem with edge decay, because if the variable starts shifting and the good days become bad days, you know, there's more room for things to go wrong. So I prefer currently running 16 strategies on XAQP. I prefer having 16 strategies that are all running low risk and exploiting simple edges, as opposed to one master system that is trying to do everything and do all the heavy lifting. Nathan, welcome, dude. GDVV, never had any analysis from you. Is interesting because my Darwin shows clearly a change of strategy. Okay, I did promise Rob that we'll do SPWL, but what I'll try and do is get 2 done today, so we can do GDVV after. But I appreciate you putting your hand up so early on and putting your Darwin forward. Mr. Player said, I tried a strategy which is basically break and retest of structure 1-to-1 risk to reward. Whenever I get a streak, I get a 7 loss streak. I get fear that strategy stopped working. It's not mine. Mimic the strategy. You need to know your max expectancy when it comes to your losses and your wins. So again, I know for every single strategy that I have in my portfolio, I know the maximum and the average win and loss streak. If you're within those parameters, absolutely fine. Of course, you're fed new data all of the time. So let's say your max loss streak has been 7 historically, and now you're running to 8 and 9 loss streak. Again, that's a question for that period of time. But if you're on a 5 or 6 loss streak, you know the max over your back test or your live trading history has been 7. So there's really nothing to worry about until that point, in my opinion. Jay Seard, from your perspective, what do you think investor weigh the highest when it comes to stats on Darwinex? For example, length of record, D-score, return to drawdown ratio, or anything else. I always say this, right? And I believe it to be true. I think the main thing an investor cares about is performance. We have Darwins that have scaled really, really quickly, that have like a year or not even a year. So if we get Colin's record up, for example, TVTA. So Colin, I believe, might be about a year. Let's have a look. Yeah, so Colin's record's turned a year old this month, and he's just scaled to 379K. So you can see he's had a pretty aggressive scaling from an investor capital perspective, which leads me to believe the length of record is less important, right? Because Colin's performance has been phenomenal. He's super stable. He's super steady. His drawdowns are really low. You can see he's at a 5% drawdown, but his equity curve, apart from the period of time where he didn't trade because of Christmas, he pretty much took 2 months off. Apart from that time, his equity curve is pretty stable. I think that is the most important aspect for any investor. They know that the risk engine we have at Darwinex is protecting them from the, worst case scenario, the more than 6.5% drawdown in any given month. They know that their risk is being managed not only by the trader, but also by Darwinex. And that way, that's why I tend to believe performance is the biggest thing. And I'm saying I tend to believe as opposed to giving you kind of a concrete answer, because every investor is different. Every investor has different reasons to get involved, or different reasons to diversify or allocate capital to a specific trader. So what might be my reason to invest in SPWL might not be somebody else's reason, for example. So I hope that answers that question good enough for you. I'm sorry I can't give you a concrete answer, but like I say, I don't think there is one. Trading Paboon, hey, welcome to the session. Appreciate you being here. Now, what we're going to do is we're going to jump into SPWL. Hopefully, we'll get time to do Nathan's GDVV afterwards as well. I just want to say, right, SPWL is traded by Rob, who's been in our Discord for a long, long time now. And I've built up quite a good relationship with Rob. I have a lot of time for him. I really like him as a person. And do you know what? I think he deserves a break. And it's really great for me to see. Looking back a year ago, there was conversations I was having with Rob that were, look, something needs to change. You need to go back to, to square one and figure out what your end goal is as a trader. How are you going to approach the markets? And I'm sure Rob won't mind me saying this. He was a little bit unsure at the time. Okay, so he was trying different things. He was being a bit aggressive with his risk, and he was just failing to capitalize on the opportunity that was in front of him. We had so many conversations, and Rob kind of took a step back, went away, rebuilt, come back, started with SPWL, and he's just done fantastic ever since. And he's currently ranked 7th out of 8,700 traders in this given month. So I want to give a huge shout out to Rob for actually taking that step back, reflecting on himself as a trader, and coming back, pushing forward, and performing the way he has performed. It's remarkable, and he should be going into gold. December, January, February, March, April. 1, 2, 3, 4, 5, 6, 7, 8. I had no break. You had no break, but you had like a mental break, right? Where you stopped doing what you were doing and you focus more on swing trading. That's what I mean. You might be going into gold this month, I think. You should be, because your record is 8 months. 8 months. I mean, to keep a 4% drawdown in 8 months, fantastic. Take a look at your stats. So you're above the 20% return for gold, and you have a 5.2 return to drawdown ratio, which is insane. So you will know if you come to these sessions often. I always say, don't ever stop trading because of allocations or gold or calibration. In this specific case, I'd say, when you're that close to being in gold, you can pretty much take a couple of weeks off now, enjoy the ride, and come back in 2 weeks' time, be in gold, and be ready to get bigger allocations and be open to investor capital. So that's a preface to this whole session. So anyway, Rob, fantastic job. Let's dive into some of the statistics. So first and foremost, one of my favorite variables is to take a look at actually where your edge works best from a time perspective, a day perspective, and your assets. These are variables that nobody should ever overlook. If you trade a specific system, whether it's algorithms or whether it's a discretionary approach, it's never going to work the same across all assets. Now, there are people out there that will tell you that it will, and when you know how to trade one thing, you can trade a whole bunch of things. But it's just not true, okay? And the more I've gotten into algorithmic trading and building portfolios, I can tell you categorically that strategies do not perform the same on all different assets. Anybody that tells you that has clearly never analyzed two data sets and done kind of like a comparative cross-reference between the two, because it's just not true. Now, let's take a look at what Rob does. So Rob's a swing trader, so there's not many trades to analyze, which is unfortunate because I kind of like to have big data sets. But this is a problem with being a swing trader, is you kind of have to be a bit more aggressive with your decision making, because you do have less trades to make those decisions on. 44% of trades come from FX, 22% from indices, and 33% from commodities. Now, the return is pretty much what you would expect. The more trades or the highest traded asset class provides us with the higher return. Now, what I generally do here is I try and work out the expected value based on the asset, and you can break it down to the singular asset too. So we can go gold, crude, NASDAQ, etc., etc. And we can look at the individual asset, because again, it's one thing breaking it down to different asset classes, which generally works because you might have appreciating assets like indices. They're not going to perform the same in general as FX pairs. Okay, because indices are designed to increase with inflation and with company and economic growth. Currencies not so much, so they do behave differently kind of in general. However, you can then break it down to how does pound yen compare to euro dollar. They're two completely different assets from a volatility perspective. From also an economic perspective, you have the BOE and the BOJ that is basically controlling the narrative of pound yen, but then you have the ECB and the Fed that controls the narrative for euro dollar. So there's so many different variables behind the scenes that, of course, if you're trying to implement a technical pattern on both of those, all the other variables are different. Okay. Going back to my point at the beginning of this session, where I don't necessarily agree that you should only ever look at technicals. And the reason being is because that technical pattern is the only one variable that is the same based on every single trade. Okay, all the other variables can be completely different, whether it's the time of day, the central bank behind the asset, whatever it may be. Okay, so I really think it's worthwhile spending some time digging into these metrics. There is a lot of assets, so we're not going to break it down by assets because there's a lot where there's only like one trade. So again, you just don't have enough of a data set to make justified decisions. However, let's take a look by group or by family. Someone's calling me. You can forget that. You can call me back later. No idea who that is. Okay, so 12%. Yeah, so as I was saying, I like to work out the expected value based on the family or the group of assets I'm trading. And the reason that I do that is because if we have a 10% return on FX, but then on also Rob said he's rejoining the screen is really blurry. Let me know if you can actually see my screen because I have no problem. Let me see if I can make the screen bigger. That might be better as well. Maybe that's better. I don't know. Should we keep it like that? At least the screen is bigger and you can probably see a little bit more. So that's probably better for you guys. We'll leave it like that for now anyway. So the reason I look at the number of trades in comparison to the return is because if you've taken 100 trades to make 10% on FX, but then you've taken 20 trades on indices to make 8%, for example, you might go, oh, well, I've made more return on FX and therefore I'm better at trading FX pairs. But when you compare the amount of return per position on average, actually you generate much higher yield by trading indices. Now, awesome. Glad to see it's better. I also made the screen bigger, Rob, so it should be easier to see. Now, again, back to that example, if you took 20 trades to make 8%, from a return per trade perspective, that the expected value is far higher than the 100 trades that yielded 10% return. Okay, and so I try and dig into, is there any low-hanging fruits there, or is there any anomalies in the data? I don't think there's much here, really. The only thing I can say where there is there's 13 trades on indices with a 6% return. But then if we look at commodities, there's 20 trades with a 5% return. So again, it's an example of what I was just talking about. There's more trades, less return. So we could say at face value, Rob is better at trading indices than he is at commodities. It's difficult with this amount of trades because one trade could completely change that. So if Rob took one trade on commodities and made 1 or 2%, that data or that idea of being a better indices trader completely goes out the window. But it's a pattern that you should be aware of, especially with this because there's something interesting there. So Rob has exactly the same win rate on indices and FX of 53.85, but then on commodities he has a much higher win rate at 70%. That's a big jump. It's almost 20%, but it's his lowest returning asset. Yeah, I mean, the record isn't early from a time perspective. I think 8 months in you're perfectly within reason to begin making changes or to analyze your data and understand where things are going well or if there's any low-hanging fruits that you can improve on. The only way it's early is from the trades perspective, so how many trades there's been. But as a swing trader, there's very little that you can do about that, right? You've just got to keep trading and building that data. But the biggest kind of standout here for me is the disparity between the win rate and the return. So Rob's win rate is 20% higher, but he's actually made less return on this this asset. Now, there's not too much to read into that, but you can take a look at your trades if you're doing the same thing on each asset. I'd be looking at, why do I win more on gold but I fail to capitalize in it? Am I winning trades on gold but I get scared because of the volatility and therefore close it early? What's my maximum favorable excursion or my maximum positive excursion look like on gold? Is it far bigger than what it is on FX? Because if I know that I have a higher win rate on gold, but I'm not quite getting the return, there's things that you can do to look at why that is. And again, the most obvious example in my head is closing trades early on gold. Can be for a whole raft of reasons, but go through your old gold trades, take a look at the winners. What is the average extension of those moves? What is your average maximum favor, or what is your average favorable excursion? What is your maximum favorable excursion? And understand that, is the room to let those trades run for longer? Because you clearly have a system that works on gold. Now can we try and improve the trade by trade basis to make a higher return on each of those trades? I know there's been times in the past, Rob, where you've kind of tongue-in-cheek said in the Discord, I've closed this trade early, missed X amount of percent or X amount of R. You already floating that idea. Maybe this is kind of the data that backs that idea up. Go through all of your trades. Have a look at your maximum favorable excursions. Understand, I'm cutting these trades for 50 pips, but in reality, on average, they're all running for 70 pips. So I'm kind of giving up 20 pips of profit on each trade on average. Okay, so something to think about. The next one, trading time distribution. This is pretty useless statistic for this specific Darwin for two reasons. One, because where it says number of trades, it actually tells you, it actually doesn't count the trades. It counts the trading action. So it counts opening of a trade and closing of a trade as if it's its own trade. Okay, so there's actually double the amount of trades that there are in the record. On top of that, Rob is a swing trader, and therefore it's kind of hard for us to decipher his higher return in the European session. Is that when he was opening the trades, or was he running it for 3 weeks and then closing it? It's very difficult to understand that kind of thing. The only idea that we can get from it is Rob generally makes a higher return during the European session. So if he has a trade that's he's been holding for a week and it's near his TP and it's during the European session, do you cut it because that's where you make the most of your return? But again, I think it's kind of a difficult statistic to make use of for this specific record. 2 seconds. Sorry, dog went on guard mode again. Okay, let's move down. Return distribution by day of the week. This is one of my absolute favorite metrics, and not many people take a look at this, which surprises me, right? The day of the week is one of the biggest variables, in my opinion, that affects so many different things when it comes to a strategy. From both a trading strategy perspective, but also a personal perspective. I always give 2 examples of this, which are real conversations that I've had with traders who I've done this session for privately. And I've gone through their metrics and I've looked at their data and I've had conversations as to, why are you performing really well on these days, but then on Wednesday you're not performing well, or on Friday you're not performing well. And these are 2 examples, real life examples of conversations that I've had with traders. One of them, their Wednesday return was so low comparative to all of their other days. All of their other days were positive performance. Their Wednesday was the only negative day. And we drilled it down to the fact that this trader only traded the European session. So they would trade European Open every single day of the week. To them, what they were doing was fully linear. They were doing it systematically. They were doing the same thing day in, day out. What we found out was on that Wednesday, that was the only day of the week that this trader took their daughter to school. And what they were doing was going to school during London Open. And so they found that they were always rushing on a Wednesday. Now, they knew this, but they didn't see the correlation between that and their performance. Okay. But what they said was when we looked at their Wednesday trades, they were going, I wouldn't have took that looking back now. It didn't do X, Y, Z. But in the moment when they were rushing, they had kind of hazy vision and they were taking trades that they shouldn't have been taking, all because they were rushing to get their daughter to school. Now, that's a very unique example. Not everybody has kids, not everybody does the school run. So it's a little bit of a unicorn. But again, what I'm trying to portray is this can go further than just, oh, my strategy underperforms on a Wednesday. It can be something that you're doing that you don't even realize within your daily routine or your weekly routine. The other one, which is a little bit funnier, was I spoke to a guy probably about a year ago whose return was poor on a Friday. And what happened was he was I can't remember what he did as a job, but he was in the trade industry, so he was like a builder or something. And what would happen is on a Friday he would finish early at like 1 p.m. He would go to the pub with his friends, he would have a couple of beers, and he would start taking trades when he was a little bit wavy. Now, what that did, of course, was screw with his perception of reality. It would make his decision-making skills far, far worse than they would be if he was sober. And therefore, his return on a Friday, it wasn't awful, but it was far below the rest of the weekdays. But what would happen with this guy specifically is he knew this. He knew he was taking trades when he'd had a couple of drinks. He knew he shouldn't be doing it. But what would happen for him and why it was so dangerous was because that was the last thing that he would do in his trading week. Then he would have 2 days off because you have the Saturday, you have the Sunday, and it cleared his head when he come back in on the Monday. He'd forgotten all about the drunken trades. Okay, so then he was back to his peak performance. He'd trade really well all week, then he'd go back to the pub on a Friday, take a couple of bad trades. And it was this vicious cycle until we kind of implemented a rule where I don't trade past 1 p.m. on a Friday. Okay, so it can be something really unique to your life or to your routine. From a strategy perspective, of course, different strategies or different strategy types are going to overperform and underperform in different conditions and different days. So a trend following strategy, if your average entry day is a Monday, of course, you're probably going to perform well or better than if your average entry day is a Wednesday or a Thursday. Because for the most part, and this is from data I've collected over the years, is that if you've got a bullish week, it's highly likely the low of the week is going to be on a Monday or a Tuesday, and the high of the week is going to be on a Friday. Same with the bearish week. Of course, there's different the numbers and the actual statistics are different per asset. But what I found as a general rule of thumb was low or high of the week is on a Monday, Tuesday, and they generally run till Friday, which forms the other side. So if you've got the high of the week on a Monday, then you'll find the low of the week is on the Friday. That's from my data. Don't take it as gospel, but that's what I found. Now, if you're trying to trade a mean reversion system on a day where you know there's going to be a reversal before the trend, so let's say a Monday, if you're trying to fade the move on the Monday as a mean reversion trader, that's when the trend is going to start for the week. So generally you might have underperformance on that day. Whereas if you go through all of your data on the assets that you trade and you find that the high of the week is usually printed on a Friday if it's a bullish week, well, you might find the perfect opportunity to short on a Friday as we hit that high of the week. Okay, which means that your performance might be greater on a Friday than it would be on a Monday, because you're picking the points where you can say categorically over the past 5, 10, 15, 50 years, the high of the week is generally placed on a Friday. And therefore that is the ideal opportunity for me to get short. Again, this is all just theory and you have to go away and look at this stuff for yourself and apply it to your own Darwins. But the purpose of this is for me to just spitball ideas of things that you might not have thought about before. Now, Rob's Darwin, SPWL, you can see that the majority of his return, the most consistent return is between 0 to 4%, right? What day is this? Tuesday. So Monday, Wednesday, Thursday, Friday is pretty much flat. He made some money, made some profit. On Wednesday, it's pretty much flat for the past 8 months. But then if we compare that to a Tuesday, there's a massive overperformance on a Tuesday. Now, I don't think this is long enough, and I don't think there's a big enough disparity between Tuesday and the next highest return day, which is a Thursday. I don't think there's a big enough gap to be like, oh my God, there's something here that needs to be explored. because again, with Rob's approach, the way he swings, two bad trades on a Tuesday, sorry, and two good trades on a Thursday could close that gap completely. Okay, if he loses 4% on a Tuesday and makes 4% on a Thursday, that gap is completely closed. So I wouldn't be worried about it too much. However, I would take note of this pattern and see how it develops over the next 12 months, 24 months. And the reason being, I always bring it up when we talk about this, is because this is THA, who is the longest or the highest capitalized trader on Darwinex. You can see they've got a 10-year long track record. So since 2015, it's 10 years in length. Now, if we take a look at the same metric, you can see that that pattern looks very, very similar. One day begins to skate away. Now, when we fast forward 10 years, we can see on a Monday, THA has never made money. He's actually down almost 8.5% on a Monday. However, on a Thursday, he's made 223%. Now, in THA's example, he is a macro trader. He waits for macro events or high impact news events, and he trades afterwards. So he waits for the release and then he takes a position afterwards. So it makes sense why his Thursday is such a high performing day compared to Monday. Monday generally has very little high impact news, especially from bigger economies like the US. And also, I actually spoke to THA about this, is he generally unwinds his losing positions on a Monday. So it makes complete sense. Thursday is generally where you have like US interest rates or Fed decisions. That sort of stuff generally comes towards the end of the week. So again, it makes sense that his Thursday return is so much higher than his other days. In this example, it's probably less to do with him going to the pub and, you know, drinking on a Monday, for example. And it is probably more strategy specific, but only you can kind of decipher whether it is routine and lifestyle or strategy specific. Let's close THA back down. Let's go to strategy analysis. So overall, there's 59 trades. Again, not a massive data set. It is split over 8 months, so I'm happy to do the analysis. I think you need more trades to be able to justify any major changes. Just because 59, it sounds like a lot, but it's really not that many. Like it says here, average daily trade frequency is 0.36. So on average, you're taking a trade every 3 days, okay, which is fine and it works, but it's just going to take you a little bit longer to build up a bigger data set, okay? You haven't, oh, that's interesting, an 84.4% long exposure. Now, I want to check whilst I'm on that SPWL. SPWL. I want to check your market correlation score. Okay, interesting. I didn't expect that. So market correlation, it basically measures your effectiveness of trading both directions in the market. So how well do you trade long versus short? Generally, the only traders that really have a low score or a higher chance of having a lower score are like long only stock and ETF traders, because of course they're more reliant on the market increasing over time. They're more reliant on these appreciating assets like index funds or company stocks. And therefore their market correlation score is lower, because during a bear market, they're going to struggle to make money. They might be able to hedge the downside, but still they're not going to perform the way they would in a bull market. Now, it's interesting that Rob has a 9.8 out of 10 score on that market correlation when he's long 85% of the time. Just goes to show that when he's short the 15% of the time outside of that, he must perform pretty well. So his short trades must be great. But 85% is high. I mean, from a direction neutral trader, I wouldn't expect it to be that high. However, Rob does trade a lot of indices and commodities, or at least gold, which again, going back to my point, are appreciating assets. So generally you always have a skew. Usually it's between 60-65% from what I've seen. 84 is extremely high, but and what's interesting is the biggest asset that Rob trades is FX anyway, and to say he still has like almost 85% long exposure is just really interesting. Hold on. Sorry about that, guys. I had a special guest. 59% win rate with an average payoff ratio of 1.74, which is absolutely solid. So anybody who's done the math before between win rate and risk to reward or payoff, this is fantastic. Like an almost 60% win rate with a 1.74 risk to reward is phenomenal. Now, basically what that means for anybody who's unaware, although I'm sure pretty much everybody watching this will be aware, the payoff ratio means Rob loses 1 on any loser, but he makes 1.74 on any winning trade on average, okay? But he's also right 60% of the time, which is phenomenal, okay? I would be trying to keep this static as long as you can. Like genuinely, if you can keep a 60% win rate moving forward and not drop that payoff ratio, like, you know, you got great things ahead. So just bear that in mind. Super high profit factor, 2.53. That's insane. I mean, I really do think, going back to my point, Rob, about our old conversations, I think you found what works for you, and I'm really glad you have, because this is fantastic. Average losing trade duration, 1 day, 2 hours. Average winning trade is 1 day, 7 hours, giving you a duration ratio of 1.19. Now, that potentially could be improved, but as a swing trader, I don't think it's necessary. And what you don't want to do is start sacrificing your win rate by trying to cut your losers earlier. The reason a positive duration ratio is so good is because it shows that the trader is willing to cut a position fast if it's a loser, but they're also happy to run a winning trade for longer. If I bring THA back up, because he has a perfect example of this, or he is a perfect example of this, strategy analysis. So you can see his duration ratio is 10.73, which means he holds winning trades for 10 times or almost 11 times longer than he holds a losing trade. So you can see average losing trade duration is 43 minutes. Average winning trade duration is 7 hours and 48 minutes. So say what you want about THA, but there's one thing you can't say, and that's that dude doesn't know how to cut losers and hold his winners, because he absolutely does. Now, with Rob specifically, because you are a swing trader, I think it may be easier to try and increase this. It's not absolutely necessary. It's not going to blow your strategy into the stratosphere. But I always want to be considering, is there any way that I can cut my losers earlier? And because you are a swing trader, maybe you can find early warning signs that this trade isn't going to play out. The only way you're going to figure that out is by going through all of your losing trades, going through all your winning trades separately, and comparing, is there any differences? It doesn't have to be from a technical perspective. Again, account for all different variables. Time of day. Okay, well, a lot of my losers enter at 11 a.m., whereas a lot of my winners, they don't enter at 11 a.m. Is there a way to, I mean, I'm just spitballing ideas here, but there's so many different things that you can look at outside of the charts to try and improve something like this. Not mandatory, you don't have to do it, but I think it's definitely worth considering, just so that you can cut losing trades shorter and try and extend winning trades for as long as you possibly can. Duration versus profit, for the guys who haven't seen this chart before, it essentially maps how long you're in the trade by how many pips you take. Anything from red and left is minus pips, so you can see minus 15, 33, 75, etc. And anything on the green side is positive. So essentially what this maps is, on average, how many pips you take based on how long you're in the market on any given trade. Now, I always think swing traders have like a danger zone down here, which Rob definitely has. So there's 8 trades where he's won within 30 minutes, and there's 7, 8, 9, 10. So he has a sub 50% win rate within 30-minute window. Now, as he goes forward, as he moves up, you can see there starts to be more congestion on the green side as opposed to the red side, which means the longer he's in the market, generally, the higher his chances of winning, or the higher his expected value is. For example, between 2 to 4 hours of being in the market, he hasn't lost a trade in that specific time window, but he's won 1, 2, 3, 4. So yes, he has 100% win rate historically. I don't like saying that because there's only 4 trades, but that is a much higher expected value regardless of the number compared to where he's lost more than he's won. Okay, so the longer Rob is in the market, generally the more pips he's going to take. That's really important to be aware of, because it allows you to sit in trades for longer, knowing that If that 30-minute window is your danger zone, where that's where you lose the majority of your trades, as you come out of that 30-minute window, fantastic. Time to sit back, relax, and let the market do its thing. I can just let it play out. Haven't got to micromanage the trade. I know that the longer I'm in the market, the higher my edge is, or the stronger my edge is, the higher my expected value is. Now it's time to let the market do its thing, and I sit back as the trader. Maximum positive and negative excursions. So this is one of my favorite metrics to track. However, I do believe that you have to track it outside of Darwinex as well. Whilst this chart is great, it doesn't track how far the market moves after you close the position, which is crucial, right? So for example, this euro dollar trade here looks like a fantastic trade. Barely any drawdown. Rob closes it close to where it peaks. But what we want to know is, outside of this, after you close a trade, did it continue to run for another 100 pips? On average, how far do all of my trades run after I close them? Okay, because you need to know if you're leaving profit on the table. You need to know this, okay? So what I do is I track every single, or at least I did when I was trading from a discretionary perspective, is I would track when I close the trade, what happens? At least to the next big peak in price or trough in price. I want to know how many pips did I lose by closing my trade early. You can also track on the downside your maximum adverse excursion, which is how far your winning trades move against you before they turn into winners. Really important to know for two different reasons. If you know that your average negative excursion is 10 pips, okay, and you're risking 50 pips on a given trade, you know that you can reduce your entry by 10 pips to a 40 pip stop instead of a 50 pip stop, because on average all of your trades go against you by 10 pips. Not as simple as that, of course. You might have to do some digging into it, but I'm just giving you a basic example so that you understand what you can use this metric for. The other thing, which is probably better, is if you go through all of your winning trades and the maximum that any of them ever went against you was 25 pips, but you're risking 50, then that's fantastic, because you know that you're risking 25 pips more than you should on any given trade. Now, if you bring your stop up by 25 pips on every single trade moving forward, you can risk more as a position sizing thing or position sizing calculation, while still risking the same fixed dollar amount, for example. So your payoff per trade is going to be far, far higher than if you're still risking 50 pips on a given trade. Those two adjustments can turn a break-even strategy into a mega profitable strategy, in my opinion, if you get it right. Not everybody can. Like, some people might already be getting the maximum out of their trades. They might be really good at finding targets or be getting the best entries. So it doesn't apply to everybody, but I think every trader should at least take a look at this, especially if you're a discretionary trader. It's easier for traders who trade with algorithms, because you can run tests and you can extend the targets and you can see over time, kind of clear as day, yeah, I should probably extend this, or I should bring my stop in. They kind of account for that when they're building a strategy and doing all the back tests. But as a discretionary trader, it's definitely a metric that you should be tracking kind of on every single trade. Value at risk has been slowly increasing over time, but you're still super low at 4.43%. Super stable. I mean, I would try and not let it go too much higher. I don't know why it's been rising. It can be affected by a few different things: asset volatility, amount of trades that you take, the time, the length of which you hold trades, and your position sizing. I don't know which one of those you've been changing, but it's clearly been affecting your VAR, but I don't think it's been affecting it too much, so I wouldn't be too concerned. If this starts getting up to 10%, I'd be looking at what you're doing and if you made any changes over the past few months. The one thing that you can't do is try and fight against this, so don't start playing with your position sizing to fight this, because you're just going to fuel the fire and your VAR is going to skyrocket, so be aware of that. It could just be volatility of the assets. It's simple as that. It could just be something simple. Now, moving over to Darwinex.com, I usually run these sessions for an hour. We'll probably run over for 10 or 15 minutes. I don't think we'll have time, unfortunately, to take a look at GDVV. So if you want me to do that, I can either do it in private or we can do it next week. We should have the guys from Edgewonk here next week again. They might not be here either next week or in 2 weeks' time. So it might be worth coming to that because you'll have feedback from the guys at Edgewonk. Also, if you'd rather me do it in private, we can jump on a call or I can record a session for you so that I can give you the feedback on GDVV. Okay, perfect. Also need to go. See you next time. Like I say, drop me a message if you want me to do it privately. If not, feel free to join the session this time next week or the following week, and we might have the guys from Edgewonk as well. But thank you, massive thank you for joining the session, being here from the start, and also putting your hand up to have your Darwin analysed. Massively, massively appreciate it. If you weren't aware, you can log into Darwinex.com and you can view your Darwinex Zero Darwins by just going. You need to be logged in, darwinex.com/Darwin/your forward ticker and then a hashtag, and it will bring up your information from Darwinex Zero. So you can see I've got SPWL, Rob's Darwin Open, and you have these different metrics down here, what we call investable attributes. Some of them are already on Darwinex Zero, so we've already looked at some of these, but I'm going to blast through the ones that we haven't looked at so far. So we have experience. Now, Rob has a 1.9 out of 10 on experience. And that is simply just due to the lack of trading activity. Rob is a swing trader, meaning he doesn't trade often. Now, that's absolutely fine, and the experience factor won't really put an investor off. The only reason it's so low is because we can't categorically say, with the amount of trading information we have from Rob, we can't say that this is going to be reflective over the next 5, 10, 50 years, right? Because we just don't have enough data to corroborate that. If Rob had 5,000 trades within the same 8-month time period, then yeah, he'd probably have a 10 out of 10 score. The only thing you need to keep doing is just keep trading. Time plus the amount of trades is going to increase your score. That's all you need to do. You can see here, average days per D period. So to get a 10 out of 10, you need like 12 D periods, which I won't get into it now. If you want to read more about it, we have a K-Base article that explains it in detail. But you can see Rob has a D period on average every 73 days, which means he will have another tick 73 days, another tick 73 days. As he gets up to 10, he's going to be scored higher on this metric. Market correlation, we've already gone over. He scored 9.8 out of 10. Which basically means he's just as effective trading short as he is trading long, which is interesting considering he's long 85% of the time. Risk stability is the VAR chart that we've already looked at. Risk adjustment is an interesting one. So he has a 9 out of 10 score on this, and this measures how often the risk engine has had to get into or intervene in any trades. So you can see those red trades here, which show how much of the position was adjusted or how much of the position was closed by the risk engine due to an increase in deleverage whilst you had exposure on that trade. So there's not many, really. There's only a few trades, but there are some. For example, there's a trade, where was it? This one, where 62.9% of the trade was closed or adjusted, meaning the risk engine reduced exposure on that position during the trade. Like I say, it measures your average deleverage, and if it exceeds a threshold within a given time period, the risk engine can intervene to keep your value at risk steady, so that an investor's not sat in a trade and all of a sudden goes from 6.5% value at risk to 8 or 9 or 12 or 50, for example. Open strategy and closed strategy. I always struggle to explain these two. So again, we do have K-Base articles that explain these in, A to Z in exact detail. However, both of them are displayed on the same screen. So regardless of whether you click open or close strategy, you have open strategy at the top and closed strategy at the bottom here. You can see Rob is 5.6 on open and 3.1 on close, which is interesting, and I'll explain why in a second. But essentially what this measures is, from a time perspective, how well does Rob time the market opening trades and closing trades. The actual maths and the differences, I'm going to refer you to the K-Base article again because it's quite difficult to explain. It essentially does it in percentages. So 10 to 50% entering the market before or after you do, and closing your trade 10 to 50% before or after you do. It's a proprietary metric built by Javier Colon, the founder of Darwinex. So like I say, I would recommend going and reading about it if you want to learn more about those metrics. The interesting thing here is Rob has a low score on closed strategy, which tells me, going back to what we figured out earlier from taking a look at the gold trades where he had a 70% win rate but a low return, is Rob closing trades too early? Okay, and we can see here that there's significant improvements to be had by playing around with these exits, because he could exit his trades before or after he does, and his score on close strategy would skyrocket. So it's worth going through, checking your maximum favorable excursions outside of Darwinex, inside of Darwinex, taking a look at your close score, seeing if we can improve that by looking at low-hanging fruits. Like, again, going back to gold, you know that you're right 70% of the time. So how much money are you leaving on the table? Compare it with your maximum favorable excursions. Take a look at your MFEs on gold. Okay, so when I close my gold positions, how far on average do they run afterwards? It's really, really important that you figure this out, because whilst you have a great strategy thus far, this can really propel it to the next level. If you figure out how to hold your winning trades for longer and for more profit, then it's going to be fantastic. Again, going back to the duration ratio, we can improve that metric, or by looking at closing trades or extending your targets. Again, what you might find is that it kind of goes nowhere, and this is just how your strategy is, but it's always worth the investigation. Again, it shows you clear as day here. The way you're exiting trades right now could do with some improvement. So it's I would recommend reading the open close strategy attribute on our K-Base on Darwinex.com. And then doing some digging into your maximum excursions as well, mainly on the exit side as opposed to the entry side. Negative, positive, and duration consistency we've already looked at. It's the duration versus pips or versus profit chart. Loss aversion 9.5, fantastic score. We've already looked at this. This is your excursions, and I did forget to say, actually, this is a pretty impressive chart. Very, very little downside. There's a little bit more at the beginning, but you seem to have reined it in without sacrificing some of the upside, which is great. I mean, just a fantastic chart. It doesn't seem like you're experiencing much drawdown on any trades, and it seems like these days you're cutting them far better. Performance 9.9, phenomenal. I mean, you are ranked 7th out of all of the traders in silver at the minute, so I'm not surprised it's so high. But this is our built-in Monte Carlo test. This compares your strategy and your performance to 10,000 uncorrelated systems, all operating with the same risk. You are currently on the 99.07th percentile, meaning that you're outperforming 9,907 traders out of 10,000, okay, which is just fantastic. Now, the reason I love this chart is because it kind of gives you instantaneous feedback of whether the changes that you make are good or bad. Okay, so if you start making some big adjustments to your system and you see that your performance just starts dropping through the Monte Carlo, you know that potentially it was a poor decision to make, and you can revert those changes and see what happens. But it's going to give you instant feedback on your performance. Rob said, I remember you mentioned about holding not too long before, but I always disagreed. Also, we'll message on this note. Yeah, just message me. We can have a chat about it. I mean, I come from, you know your strategy way better than I do, right? You understand what you do, how you manage trades and stuff. I'm just looking at the data from an unbiased perspective. I'm talking about what I see, and what I see is kind of telling me that there's work to be done on your exits. Again, there's a saying called formulas, not feelings. I think I heard that when it comes to property, but it's like relevant here, right? Especially relevant with traders. I generally find most traders are very emotional about their system. I'm not saying you are, Rob. I'm just saying in general. A lot of traders are very emotional, and they take offense when somebody suggests an improvement, right? Again, this is not about you, Rob. I'm just saying in general. But when you're analyzing somebody else's trading strategy, you don't have that emotion. And again, you're using formulas and not feelings. You're looking at the statistics and the data from an unbiased perspective. You don't care about the strategy. You don't care about how you manage the trades. You're just looking at the stats. And the stats are telling me that there could be work to be done on exits. Again, like I say, you might find that the strategy only performs well because you exit the way that you do, but that you still have to do that kind of investigative work into it to figure that out. Capacity 6.6. As a swing trader, I'm presuming that your max investment is going to be fairly high anyway, because you let your trades breathe. Essentially, what capacity measures is how much investment you can handle as a trader, or more relevant, how much investment your strategy can handle. So what we do is we measure the toxicity flow of your orders, and then we measure from that flow what would the divergence be if between yourself and an investor, if the investor was getting slipped by X amount of pips? We then cut the strategy off if we know that because of the size, an investor is going to be getting slipped by zero point 0.2 pips. That's when we would stop accepting investment into your strategy, because it goes through our asset management license and it's us on the line. If we promote your strategy as 20% per year with a 5% drawdown, but then your investor's getting 10% per year with a 10% drawdown because they've just got too much size for the market to handle or for the liquidity provider to handle. Now you can see since the beginning, this was last measured on Thursday, August the 14th. So it's not been updated since then. You had a 22.55% return. But if your investors were getting slipped by 0.2 pips, they'd have had a 21.87% return, which isn't too bad, actually. If your investors were getting slipped by 2 pips, they'd have had a 15.88% return. That's a disparity of about 7%. Okay, so that's an absolute no-go. We can't advertise your strategy knowing that an investor is going to get 7%. So we ensure that we don't take too much investment into a strategy that the liquidity provider won't be able to manage. And so you can see here, if we scroll down, you can see his capacity, max estimated investment on the Darwin, and you're currently sat at 22.95 million US dollars, which I did think it would be. I thought it'd be in the tens of millions. So you sat about 23 million, which is fantastic. There's literally nothing to worry about. I mean, if you get an investor who's got 23 million to fill up your pot, then, maybe then it's something to worry about. What don't you understand, Rob? Just so I can try and explain it in a more clearer way. If you let me know what, because I might not have explained it very well. Just waiting for Rob to respond. But anyway, your max estimated investment is 23 million. So essentially what that means is at 23 million, your strategy will be cut off and no more investors will be allowed to invest capital into your strategy, because that is the alpha cap of your system anymore, and the system will start being less effective. What you mentioned before, but can't remember. Oh yeah, getting slipped. And do you mean 23 million max investments? How do you up that? Okay, so up in that is it's like a chicken and egg problem. You have to change your strategy, but it's different per strategy. There's a lot of commonsensical things, like, which you already do, to be fair. Okay, so if you're trading with a 2 pip stop, your investors are gonna get slipped on that. So you're probably gonna have a max investment of like 50k or 100k. If you're trading with a wider stop and you're letting your positions breathe, you're holding them for longer, or you stagger your entries, generally you're going to be able to take more capital on, because you're not just throwing a huge amount of capital into every given trade. Okay, lowering your position sizing for singular positions, again, is another way. Trading more liquid pairs, all of these sorts of things combined will increase your AUM. But at 23 million, that's nothing to worry about. I would begin worrying about that when you get to 10 mil. And I'd be going, well, if I get another 10 million, I need to be concerned about increasing it or building a separate strategy to scale. But 23 mil, it's kind of like you could go and work at a hedge fund or a bank or a prop desk, and you're probably not going to get back to 23 million for a few years anyway. And through Darwinex, that's probably going to take you 5 years, 10 years of the same performance anyway. Maybe not, who knows? You could scale really quickly, but like I say, it's not an immediate concern. It's not an immediate worry. Exactly, you can change the higher time frame, but I mean, you already trade higher time frame, right? So I wouldn't be too concerned about that. It's more the guys who are either trading exotic pairs or trading with a 2 to 5 pip stop or anything like that. They're the kind of people, or holding a trade for 30 seconds. They're the kind of people who are going to really struggle to take on excessive investor capital. And yeah, 23 million is a hell of a lot. Like, when you deep that, 23 million is huge amount of AUM. And therefore, like I say, I wouldn't be worrying about it. I'd be worrying about my first million, and then my 5th million, then my 10th million. At that point, I'd be going, okay, now let's try and expand how much capital we can manage. But until that point, I wouldn't be too concerned. But anyway, guys, I'm going to call it an end of the session here because we have run over by 10 minutes, which is absolutely fine. I want to thank you all for joining. Rob, I want to say a massive well done for what you've achieved over the past 8 months and beforehand as well. And a massive thank you for putting your hand up and letting me take a look at SPWL today. If you enjoy these sessions, please let me know, because, or if you want me to change them in any way, I'm more than happy to kind of take your guys' feedback on and see what I can do. I appreciate I probably drone on sometimes and it's not the most exciting thing to listen to. However, I hope you take some value from this. And if you want me to analyze your Darwin in future, we run these sessions every Wednesday at 4 p.m. UK time. So feel free to come along whenever you're free, or you can watch them on repeat and take what we talk about on the session and go implement it on your own account. JC, glad to see that you're still around. And attended for the whole session. So I appreciate that. I appreciate everybody's comments, everybody coming and watching it. Rob, I appreciate you too, dude. I hope you all have a fantastic rest of your evening, morning, or afternoon, wherever you are in the world. Have a great rest of your day, and I will catch you in the next session. Peace out, guys. See you later.